yeah, I wanted to do a bit of a talk through the Temporary Repatriation Facility, or TRF, as it's a relatively important piece of legislation or a good opportunity for non-DOMs who are remaining in the UK. So where to start? I think everybody's aware that there were huge changes to the non-DOM regime effective from 6th of April this year, which has effectively been abolished. So domicile's no longer a connecting factor for UK tax purposes. Linked to this, the remittance basis of taxation has been cut, so that's no longer available for non-DOMs living in the UK or former non-DOMs. UK tax residents, well, most UK tax residents, not including those in their first 4 years of tax residence, will now be taxable on worldwide income and gains on an arising basis. And for inheritance tax purposes, we now have this concept of long-term residence to replace domicile. I won't go into that too much today, but long-term resident, basically, if you're in the UK for 10 or more of the last 20 years, you will be subject to UK IHT on worldwide estate. So what hasn't changed, and this is quite an important point, and that is that anyone who has previously used the remittance basis, the taxation, or they will still be subject to UK tax if they remit any foreign income and gains that have previously been sheltered from UK tax under a remittance basis claim. So that's a quick recap on what has and hasn't happened. And it leads us nicely into the Temporary Repatriation Facility. So what is the TRF and what are the reasons for it? The government realised when they abolished the remittance basis that it could be a bit of a problem in terms of people wanting to leave the UK and attracting capital into the UK. So the idea of the TRF is to give a tax relief or a tax reduction to try and encourage people to bring overseas capital and invest it into the UK economy with a view to growing GDP. So in very brief highlights, the TRF is going to be available for 3 tax years from 6th of April 2025. So it will cover 25-26, 26-27 and 27-28. Anyone who chooses to make designations under the TRF, and we'll go into a bit more detail on what that means shortly, will be able to pay a reduced rate of 12% on designations made in 25-26 or 26-27, and then a slightly higher rate of 15% on designations made in 27-28. And this is what will now be called the TRF charge. The TRF charge itself will be payable on the designation, not necessarily on a remittance. So you can make a designation and then there's no requirement to actually bring those funds into the UK immediately. So you're just free to have this designated capital sat offshore until such time as you need it. And again, we'll look at planning on that in a bit more detail shortly. So moving forwards, who can use the TRF? This is very important. So the TRF is available to individuals and to individuals only. In order to claim, the individual has to be UK resident in the tax year of designation. They have to have previously been subject to the remittance basis for at least 1 tax year before 25-26. And this includes years where the remittance basis applied automatically. And finally, they have to have qualifying overseas capital available to designate. We'll look at what is qualifying overseas capital very shortly. So qualifying overseas capital, the simple definition, or the not so simple definition, but it's an amount of capital will be qualifying overseas capital where it falls within one of the following categories. includes foreign income or gains that arose in a tax year prior to 25-26, which was subject to a remittance basis claim. So this includes amounts that have not been remitted to the UK or amounts that can be remitted during the TRF period. It can also include amounts held overseas immediately before 6th of April 25, which are of an uncertain source. The only caveat on that is that the funds have to have been situated outside the UK since they were acquired. And it also applies to certain distributions or benefits received from non-UK trust, where these can be matched to pre-April 25 income or gains of the trust. We're not going to go into too much detail on the trust today. It's an additional level of complexity that is difficult to do in a single webinar. But if anyone's got questions around that or has issues around trusts, then we're more than happy to discuss those with you on a separate case-by-case basis. So moving forwards, still looking at what constitutes qualifying overseas capital. In practical terms, QOC will include capital derived from or including the following: investment income held in overseas bank or other financial accounts, so stockbroker accounts, capital gains which have arisen from the sale of offshore assets when those proceeds are held in an overseas bank or other financial institution, income from employment which is held overseas, or foreign income or gains within offshore trust structures. So the designation process, designations need to be made on an individual's tax return. And as previously said, they can be made in 25-26, 26-27, or 27-28 tax years. So whilst we've got this 3-year period, it fundamentally gets extended by a year due to the ability to resubmit tax returns or make amendments. You've got that 12-year period. So for the 27-28 tax year, the filing deadline is January 29, but the amendment deadline is January 30. So realistically, someone's got until January 2030 to make a designation under the TRF. So we can extend the 3-year period to effectively 4 years within the normal resubmission deadlines. The designation itself, it needs to set out the total amount of designated income and identify which, if any, of the amounts designated have been remitted to the UK during the tax year. Now, it's not clear yet exactly what format these designations are going to take on tax returns. As with the foreign income and gains regime, we know there's a duty to report any income that isn't being reported or is being relieved under the FIG regime, but we haven't yet seen the tax returns, so it's uncertain exactly what information or exactly how these reports, these designations will be made, but there is that requirement to put these onto a tax return. And it's also important that you as advisors or taxpayers keep records of amounts designated. So it's going to be similar to the previous regime where you would have been keeping a close eye on clean capital. You now want to keep a close eye on designated amounts under the TRF. So we've made the designation, but when does the charge apply and when is it payable? So the TRF charge is due on the total amount of designated qualifying overseas capital. It's not linked to the amount remitted, it's linked to the amount designated. So I think in reality, what we're likely to see is individuals who plan to stay in the UK for another 2, 3, 4, 5 years or stay in the UK indefinitely, who may have a mixed fund outside of the UK, and they know that they're going to burn through £100,000, £200,000 a year whilst they remain here. So they might look to designate an amount that's going to cover the 5 years they expect to stay in the UK. So it could be that in 25-26, we make a designation over £1 million of qualifying overseas capital. And the charge for 25-26 will then be on that £1 million with no charge on any future remittances of that designated amount. So the TRF charge itself is simply payable via the self-assessment system, as if it was income for the year in which the designation relates. And just to recap again, the TRF charge is 12% for 25-26 and 26-27, and 15% for 27-28. So where possible, you would make designations in the first 2 years, or if you were looking to make a designation 27-28, it might be worth using the amendment window to push that designation back into 26-27 and therefore secure the lower 12% rate rather than paying the higher rate for a 27-28 designation. Another key point with regard to the charges is that whilst these are effectively treated as an income or a tax on income, it won't be brought into account for payment on account purposes. So if you were to make a designation over, say, £100,000 in a given tax year, that charge of £12,000 is not going to add £12,000 onto your payments on account for the following tax year. It will just be a standalone amount, more like a capital gain, but taxed as income in the year that it's payable. Another thing to be a little bit mindful of is under the old remittance basis regime, for individuals who were subject to the remittance basis charge, it was possible to pay that amount directly to HMRC and it not be treated as a taxable remittance. So you could have paid from a mixed fund or a dirty fund, for want of a better phrase, direct to HMRC to cover the remittance basis charge, and that would not be a taxable remittance. The same doesn't apply for TRF charge payments. So if you were to make a designation and then pay from a fund that's not the designated fund, that isn't entirely clean capital, that amount will be treated as a standalone remittance. So it's just a point for care and planning when you're making these charges or these designations for clients. So we've just touched on the mixed fund concept, which I'm hoping is going to be familiar to any non-DOMs listening to this or anyone who's listening to this who advises non-DOM clients. But just as a recap, a mixed fund is fundamentally any fund which is not purely clean capital. Clean capital, of course, is any pre-residence income or gains, basically any funds that anybody had prior to coming to the UK, which haven't been tainted or topped up with foreign income or gains sheltered from UK tax under the remittance basis during the period of UK residence. So historically, people would have probably had their account structured such that they had a clean capital account with any income or gains being paid into a separate sub-account so that they could be ring-fenced, leaving this clean capital pot to be freely remitted to the UK without a charge. So under the old regime, and the new regime, to be honest, remittances from mixed funds, it was relatively complex in some circumstances to determine exactly what was being remitted to the UK, and there was a complex ordering process to determine what of the constituency parts of that fund were being remitted, and therefore what the tax would be on those remittances. The TRF has allowed us some simplification of this, in that it's given us new ordering rules and the concept, and introduced a new concept of a TRF capital account. In very simple terms, I guess a TRF capital account is just a new clean capital account, which is created by the designation of funds. So the modification to the ordering rules there's two modifications fundamentally. First is that designated amounts, so TRF capital, are always now going to be treated as being remitted to the UK in priority to any other amounts, regardless of the tax year in which they arose. So if you've got your mixed fund and you decide to keep it in a mixed fund, then make an election or a designation. That designated amount will rise to the top, and all remittances from that account will first utilise the designated amounts under the TRF. And once that's been exhausted, if no other election is made, you will then be remitting the mixed fund, and the same rules as pre-April 25 will apply on remittance of those. The other simplification is that during the TRF period, when we're looking at mixed funds, TRF capital is going to be looked at on an annualised basis. So we don't have to look at transaction by transaction level. We can just look at a whole tax year as a sort of sub-pot, which makes life a lot easier in terms of analysis for former remittance basis users and their advisors. So there's good opportunity here. As with everything, it just needs a little bit of planning and a little bit of care when looking at these matters. So just looking in a bit more detail about mixed funds under the TRF. So the TRF capital account, it gives us another benefit. It provides us with a defined fund, very similar to a clean capital account, which just makes it easier to manage remittances. So as discussed a minute ago, normally a transfer from a mixed fund that isn't remitted to the UK. Sorry, I've confused myself here. I'll go back a bit. So where we've got offshore transfers, if you go from a mixed fund into another account, the balance of that other account will be made up of percentages of the underlying capital in the old mixed fund. Where we make a designation and we have TRF capital, that again sort of cleans that bit up a little bit. So we can have this new fund and it's all TRF capital and we know exactly what it is that's being remitted. Once you've got that separated fund of designated amounts under the TRF, it would be very sensible for individuals who've made that designation not to remit or not to use those funds for any expenditure outside of the UK, and instead to carry on utilising the mixed fund, the undesignated mixed funds, for funding non-UK expenditure. And that way we keep this designated pot as large as possible, and we're not paying tax unnecessarily on foreign expenditure or monies used for foreign expenditure. So as you can imagine, these TRF capital accounts, they do have conditions which apply to them. The first of which, rather unsurprisingly, is that the TRF account has to be an overseas bank account. And immediately before the receipt of the TRF capital, this account must have had a balance of £10 or less. So realistically, this probably means that you're going to want to set up a new bank account or a new sub-account with an account overseas and make the designation, transfer your TRF capital into that account, and then you've got a very clean pot to remit from. If you transfer TRF capital to another account that's, say, another mixed fund that had a balance of more than £10, you've then sort of squandered that TRF capital, and we're back into a mixed fund basis. And the other point is that HMRC need to be notified of the details of the account, by the 31st of January following the end of the tax year. So by the filing deadline, when you're doing your return, you need to tell HMRC somewhere on the tax return that XYZ account has been set up, and it's that account which holds your TRF capital. So again, it's a little bit of disclosure, but I think the trade-off of that disclosure is that you've got this pot of capital which you can bring in, and you've paid a much reduced rate of tax on that account. So I guess this leads us to the question of when should people consider using the TRF? This is very much going to be a case by case, as with most things, but when wouldn't you use the TRF is probably a good place to start. I think anybody who has either not an intention to remain in the UK indefinitely, or has enough pre-residence clean capital to support their UK expenditure for as long as, well, for the rest of their lives, or for as long as they expect to remain in the UK, there would be precious little point in making a TRF designation and triggering a tax charge when you've already got enough clean capital which you can remit tax-free. So that would be a situation where you probably wouldn't make this election. But the flip side to that is when it is useful. And the designation, or the TRF, is going to be used by former non-DOMs, who we're now calling long-term residents, who either expect to stay in the UK forever, or they know that they're going to be here for another 5 years, 10 years, whilst the children are going through school, for example, and they don't have enough clean capital to support that lifestyle, their expenditure for the period of time that they expect to be here. So for them, that's the prime opportunity to utilise the TRF whilst we've got this limited window of 3 years. So again, it would be a case of working out cash flow, trying to have a best guess as to what your burn rate of cash would be over the period, and making elections or designations under the TRF just to secure a lower tax rate on amounts that you know you're going to remit at some point in the future. Now, whether you need to do that all at once, or whether you can look at it, make a designation in this tax year, see how things go, you could then make another designation next year, and you can make a further designation in 27-28, or indeed under the amendment window effectively in 28-29, although it would apply to 27-28. So we've got a bit of breathing room here. So for people who are perhaps unsure whether they will or won't stay in the UK, but they need 12-18 months to try and work out where it is they might want to go, or whether it is actually the right decision to leave the UK, then you might want to make a smaller designation to start with, and then top that up as and when sort of plans have been formalised, certified, whatever, going forward. So I think that pretty much covers the main points there. Again, probably a bit rambly, but it's very difficult to say exactly when someone should use the TRF. It's all going to be very much personal circumstances. But yeah, there's times when you shouldn't use it. There's times when you should use it. And there's times where you can take a sort of hedged approach to it. And I think just open conversation between you and your advisor, or for advisors between you and your client, to understand exactly what cash might be needed, what the situation is, and then we can formulate a proper, structured, effective financial plan for those individuals to take advantage of the TRF to manage UK cash flow going forwards. So just to put this in a bit of context of how the TRF works, how the designations work, the theory is all very good, but real world examples probably work a little bit better. So in this first case study, we're looking at Sergio. So Sergio is a UK resident and a former remittance basis user. He has an overseas bank account, and that account contains £500,000 of foreign dividend income, which arose during 21-22, 22-23, and 23-24 tax years, and he made a remittance basis claim for those years. So that £500,000 of dividend income has not been taxed. So if Sergio were to bring that into the UK without making a claim or designation under the TRF, that would be treated as a remittance of foreign income and subject to tax at his marginal rates. So we also know that Sergio hasn't made any remittances to the UK from this account, but he intends to do so in the future. So for Sergio, therefore, it makes sense to designate some of this income on his 25-26 tax return. So how will this work? So we need to make sure that we meet the qualifying conditions of qualifying overseas capital. The first one of those is met. It's foreign income which arose prior to 6th of April 25. The second condition's been met. It's not been remitted to the UK. And the third condition has also been met, being that if it were remitted to the UK, it would be subject to income tax. So if Sergio wanted to designate this whole amount, this whole 500,000 on his 25-26 tax return and pay the TRF charge, we'd have £500,000 at a tax rate of 12%. So there'd be a £60,000 tax charge, which would be payable by 31st of January 2027. And Sergio is then free to remit any or all of that £500,000 into the UK, either during the 25-26 tax year or at any point in the future, and there won't be an additional tax charge. If he didn't do this and left it until 28-29, and then or later, and then decided he needed to bring the money into the UK, we're looking at tax rates of up to 45% on that remittance, which even if you were to bring a quarter of the money into the UK, the tax charge on that would far exceed the charge on this full 500,000 with a TRF designation. So scenario one was relatively clean in that we had one bank account that was made up solely of foreign income. In this second case study, we're looking at Christina, and Christina's got a mixed fund bank account. So on 6th of April 2025, that account contained the following. There was £400,000 of foreign income from the 24-25 tax year, £125,000 worth of foreign gains, again from 24-25, and £75,000 of foreign gains from 22-23. So if in 25-26, Christina were to designate £300,000 of foreign income and pay the TRF charge at 12% of £36,000, we would then have a situation where the sort of makeup of this mixed fund would have changed. So the mixture or the composure of that mixed fund is now going to look like this. So there would be £300,000 worth of TRF capital. There'd be £100,000 worth of foreign income from 24-25, £125,000 of foreign gains from 24-25, and £75,000 of foreign gains from 22-23. So what we see here is the application of the new mixed fund rules where a designation's been made, the designated amount rises to the top, and any remittances will be treated as first coming from that TRF capital. So alternatively, Christina could set up a separate TRF capital account and she could transfer that 300,000 into the TRF capital account. And then we've got a completely ring-fenced account which can be remitted to the UK without further charge arising. And again, as alluded to previously, it would be very sensible for Christina to ensure that none of that £300,000 is spent outside of the UK. Otherwise, we're paying a 12% tax rate on non-UK spend, which is completely unnecessary. So we would, once we've transferred this 300,000 into the new TRF capital account, we can spend from the other mixed fund when we're outside of the UK, and that way there's no UK tax charge on that foreign spend. So our final example, and I think this is probably one of the potentially biggest benefits of the TRF, is where we've got a situation of uncertain mixed funds. So in this situation, we're looking at Sophia. Sophia is a UK resident and a former remittance basis user. At the start of this tax year, so 6th of April 25, she had an overseas bank account that had a balance of £750,000. Now, whilst she knows some of the source of that fund, she's not certain of exactly where all of it came from. So we know that, or Sophia knows that £450,000 of the balance of that account is related to a foreign gain, which arose from the sale of an offshore property, and she was subject to the remittance basis for that year. The balance of 300,000, she's got no idea where this has come from. So it could be foreign income, it could be foreign gains, it could be clean capital, but being prudent, we would probably advise without the TRF not to remit that amount. So looking at the ability to designate uncertain amounts, we can say that we know it's qualifying overseas capital. We know it was held before 6th of April 25, and we know it's been situated outside the UK for the full time that it's been held by Sophia. So Sophia now has the option to designate that 300,000 under the TRF, and she can also designate the 450,000 if she wants to. And once designated as TRF capital, and once she's paid the TRF charge, Sophia can remit that uncertain sourced money into the UK without triggering an additional charge to tax. Similarly, she can remit the 450 of capital gain. So we've got a situation here where we've got 750,000, which, if remitted, would have been subject to far higher rates of tax. But by making the designation, A, the gain can be remitted at 12%, and B, this uncertain sourced 300,000 can be remitted at a 12% rate. So it's a huge advantage for sort of cleansing mixed funds, and it gives another opportunity that hasn't really been seen since the last cleansing regime back in, I think, 2017. So that brings us to an end of the slides that I wanted to go through today. Hopefully that was as clear as it can be for a new area of legislation. If anybody's got any questions, please feel free to drop them into the chat and we can try and pick those up. Equally, if you don't want to raise anything now, please feel free to contact me via hello@rpgcc and be happy to pick up any questions that you've got going forwards.